The next funding solution that we will talk about is considered to be a permanent solution, okay? Generally, once you lock in and you take out a refinance in the form of a cash out refinance, you don't have interest only payments for the most part, and you will not have to refinance that loan if you absolutely do not want to or the conditions allow for themselves. Of course, if interest rates come down, you can always refinance in order to reduce your cost. But what a cash out refinance is it is taking your current mortgage, so instead of the HELOC where you're leaving your mortgage in place and you're stacking another mortgage on top of that, a cash out refinance will take your existing mortgage, refinance the whole shebang, while you're extracting the cash out that you need in the form of a lump sum. So that's the other difference. Where the HELOC will fund it to you in the form of a big credit card and you can draw as you need, the refinance cash out is going to give it all to you, boom, $300,000, there you go. Which also means you have to start paying for it right away, right? So your new fully amortized permanent payment is going to be reflective of that entire balance that you just drew out, including that new lump sum. And if the interest rates have changed the way that they have recently, then the entire mortgage balance will be subjected to that interest rate as well. So technically you're swapping out your current mortgage for a new one, but bigger, and giving you cash back. That cash back can be used for anything that you want to use it for. You could use it for your renovations. You could use it for to pay off your car loans and debts so that you can save that monthly amount of money and contribute that towards the things that you need, like your renovations. So internal and external appraisal required. The home needs to be free of health and safety issues. So if we are dealing with having an internal and external appraisal, and we are going after this cash out refinance, the appraiser is going to make sure that before we land on that home, the home is free of any health and safety issues. That means the deferred maintenance, right? I have had a number of folks come to me and say, hey Judy, I want to do a refinance cash out. I need 200 grand. I'm going to put a second story on for my mom. She's going to move in. And we send the appraiser out, and then they find that there's termites in the rafters and that needs to be fixed. And then they tell me, well, yeah, we're doing a refinance, right? We're gonna do some renovations. We're gonna fix that stuff. What's the problem? The problem is at the loan closing, the home needs to be free of any type of health and safety issues. And termites, structural damage, is considered a health and safety issue. We don't know when there may be a hurricane that comes through and blows your roof off and kills everybody in the house, right? So because of that, we cannot move forward until those items are fixed, which seems like you're doing the work twice, okay? So that's one of the things that you want to keep in mind, and then we'll talk about the solution to that with the renovation loans. And then also, whenever we are dealing with a cash out refinance, using the as-is value of the appraisal. And this is very, very, very important because the renovation loan that we're going to talk about is going to allow you to use the after improved value. So what that means is that whatever renovations you are going to do, even if you have amazing plans to turn it into a mansion, the appraiser will consider none of that when he is appraising your home for a cash out refinance. Your home will be appraised as it is now, without any renovations, and it needs to be clear of the health and safety issues. The good news about doing a cash out refinance, as long as you meet all of that criteria, is that the interest rates can be fixed. That means that the payment is, and most of us are familiar with that, in the form of a 30-year fixed, right? A regular old mortgage. Fully amortized, meaning that each payment that you make is scheduled over 360 months. So as long as you make every single payment, the loan will pay off. Unlike the HELOC, where you could make every scheduled payment and still owe $500,000 at the end, right? So this is a fully amortized payment. So just like a traditional loan, 360 months, and as long as you're making every single payment in 30 years, you will be free of this debt. And that is what we call your freedom point, right? When you are free of this debt and you no longer have to make mortgage payments. Because it is a permanent loan, you do not need to refinance later. You're never going to be stuck in an interest-only situation and owing that big balance. And then the homeowner is in control of the monies and how it is spent. Because once again, you refinance, you extract the equity you want, you put it in your bank account, and you start to make those decisions about your contractor, what monies he needs, what you're going to spend, and you can negotiate that stuff from there.